The United States dollar's 80-year reign is officially entering its end game as the global financial plumbing begins to freeze under a $34 trillion debt trap.
Macro specialist George Gammon and veteran economist Peter Schiff warn that the Fed is now mathematically trapped, and we have distilled their hours of complex analysis into these eye-powered insights.
Get ready to see the Godzilla benchmark keeps feeling. Nick Gerli says is stomping the housing market, and why Jeff Snider believes Goldman Sachs just confirmed the worst-case scenario.
We start with George Gammon, who reveals the exact moment the dollar's fate was sealed by a $300 billion mistake.
We are diving straight into George Gammon's latest breakdown on why the US dollar's dominance is officially entering its endgame.
George's analysis is clear. The weaponization of the dollar through sanctions has triggered a global shift that cannot be reversed.
Wait, weaponization? Are we talking about literal weapons or just money?
It is about using the global payment system as a political cudgel, and George says it is backfiring spectacularly.
Exactly. While the dollar looks strong on paper today, the data shows a massive move into gold and alternative currencies that we need to watch.
George Gammon explains that we are moving from a unipolar world, where the dollar was the only game in town, to a multipolar one.
And that means the exorbitant privilege the US has enjoyed for 80 years is melting away.
Wait, so if the dollar is not the king anymore, what happens to my bank account?
It means your purchasing power is at risk, as the world stops needing to hold dollars to buy oil or gold.
Well, that sounds like a great time to start paying attention.
George Gammon argues the turning point was the freezing of $300 billion of Russian central bank reserves.
Right? He points out that if you prove the risk-free asset can be turned off at a whim, it is no longer risk-free.
Hold on, 300 billion. That is a lot of zeros to just freeze.
It is massive. And now every other country, especially China and the BRICS nations, is asking, are we next?
So the very thing that gave the dollar power, its ubiquity, is now making it a liability for foreign nations.
So they are basically looking for the exit door.
The data backs George up. Central bank gold buying reached a 55-year high in 2022.
George notes that central banks are not buying dollars. They are buying the only asset that does not have counterparty risk.
Counterparty risk. Can you say that in English for me?
It means gold does not rely on a government's promise or a bank's stability. It just is.
And when the BRICS countries, Brazil, Russia, India, China, and South Africa, start trading in gold or their own currencies, demand for the dollar drops.
So, if they do not need dollars, we can't just print them for free anymore.
Exactly, the party is ending. George Gammon warns that the solution the elites will offer for this dollar crisis is a central bank digital currency, or CBDC.
He describes it as a programmable money system that gives the government total control over your spending.
Wait, so they could just tell me I cannot buy a steak because I've hit my carbon limit?
That is exactly what George is concerned about. It is not just about the economy, it is about absolute control.
He thinks they will use the chaos of a dollar collapse to force everyone into this new digital system.
Suddenly, that physical gold sounds like a much better idea.
George often references Triffin's dilemma, the idea that the reserve currency issuer must run constant deficits to supply the world with liquidity.
But those deficits eventually lead to a loss of confidence. It is a mathematical trap that the US is now stuck in.
So we have to go into debt to keep the world running, but the debt eventually kills the currency?
Precisely. George points out that we have reached the point where the interest on the debt is exceeding the defense budget.
When the math stops working, the system has to reset. George says that reset is starting now.
I was told there would be no math. But this sounds like a disaster.
George predicts a great bifurcation, the world splitting into a Western bloc and a BRICS plus bloc.
One side will stick with the dollar for as long as possible, while the other moves to commodity-backed trade.
So we are going back to the Cold War, but with money instead of missiles.
Financial warfare, essentially. George believes this will lead to persistent inflation in the West as we lose access to cheap goods.
It means the era of low prices and endless debt is officially over.
Great, so everything stays expensive forever. Love that.
Ultimately, George Gammon sees gold reclaiming its throne as the anchor of global finance.
He thinks that to restore trust, any new trade currency will have to be at least partially backed by physical commodities.
Because you can't just print more gold out of thin air, right?
Exactly. You have to dig it out of the ground. It forces honesty back into the system.
Which is why George suggests having 10% of your portfolio in physical gold as insurance.
Insurance against the end game. Got it.
George's main takeaway is to own physical assets that the government cannot inflate away.
Gold and silver are his top picks for preserving wealth during this transition.
So I should buy the shiny stuff and hide it under my mattress?
Maybe a safe instead of a mattress, but the principle is the same. If you don't hold it, you don't own it.
George also suggests keeping an eye on the dollar index, or DXY, and any news regarding BRICS expansion.
Those are the leading indicators. If more countries join the BRICS, the dollar's endgame moves faster.
So if the news says Saudi Arabia joins BRICS, I should probably check my gold stash.
That would be a massive signal. George says the endgame is a process, not an event. Stay frosty. The headlines say the Fed is fighting inflation, but Peter Schiff's recent talk with Michel Macquarie paints a much darker picture.
Schiff is sounding the alarm that the Fed is officially trapped by our $34 trillion national debt. They can't raise rats without bankrupting the government.
Wait, 34 trillion? That's such a big number, it doesn't even sound real anymore. How do you even pay interest on that?
That's exactly Schiff's point. We can't. Which means the only choice left is to print more money and let inflation run wild. Here is the bottom line. Peter believes the dollar is headed for a massive devaluation because it's the only way the Treasury stays solvent.
Exactly. If they can't pay the debt with real money, they'll pay it with printed money that's worth significantly less.
So my savings account is basically a melting ice cube in this scenario.
More like a puddle. But hold on, because Schiff also explains why the hawks at the Fed have actually gone extinct. We'll get to that shortly. Michel Macquarie brought up a staggering state. Interest payments on the debt are now surpassing the entire U.S. defense budget.
It's true. Peter Schiff notes that we are spending more on the past, paying back what we borrowed, than on our current security.
Hold on, more than the military. We spend a fortune on that. How did we let interest get that high?
It happens when you keep interest rates at zero for too long and then try to raise them. The bill finally came due.
And Peter says, this is a mathematical dead end. There's no scenario where this ends well for the currency.
So we're basically maxing out the national credit card just to pay the interest on the national credit card.
Peter Schiff says hawks are extinct. No one at the Fed actually has the stomach to do what Volcker did in the 80s.
Right? To stop this inflation, you'd need to raise rates to double digits, which would cause a total systemic collapse.
Wait, I keep hearing the Fed might raise rates one more time. Is that just a bluff?
According to Schiff, it's all theater. They talk tough to keep the markets from panicking, but they're terrified of a real recession.
So they're pretending to be hawks while acting like doves.
Great. So our economic pilots are just pretending to hold the controls while the plane dives.
Schiff's analysis highlights that inflation is just a tax that nobody voted for. It's how the government pays for things without raising income taxes.
It's a wealth transfer. If you have cash, the government is essentially siphoning off your purchasing power to fund their deficit.
So when my groceries go up 20%, that's basically me paying for a government program I didn't ask for.
Exactly. Peter argues that as long as the deficit stays huge, inflation cannot be cured.
It's the ultimate shell game, and the middle class is the one losing the money.
I think I like the shell game better when it was just a trick on the street corner.
Given the debt trap, Schiff is doubling down on gold. He tells Michel that gold is the only real money left.
He points out that central banks around the world are buying gold at record paces. They see the writing on the wall for the dollar.
If the central banks are ditching dollars for gold, shouldn't we be doing the same thing?
That's exactly Peter's point. Gold has no counterparty risk. It can't be printed into oblivion by a central bank.
It's the ultimate insurance policy against the Fed's extinct hawks.
So basically, buy yellow metal, because the green paper is turning into confetti.
What's the timeline here? Schiff predicts gold will hit massive new highs once the Fed is forced to cut rates to save the banks.
He's looking at a scenario where the economy weakens so much the Fed has to print again regardless of inflation.
Wait, if inflation is already high and they print more money, doesn't that just lead to hyperinflation?
That is Peter's warning. He thinks we're looking at a 1970s-style stagflation, but on steroids because of the debt level.
It's a total loss of confidence in the dollar's purchasing power.
Stagflation on steroids sounds like a very bad workout plan.
Peter also predicts a looming fiscal crisis that will eventually force the government to slash spending, whether they want to or not.
Right? Either we cut spending voluntarily or the market does it for us by refusing to buy our debt.
So what happens if people stop buying our debt? Does the government just shut down?
Usually, the currency collapses first. You get a sovereign debt crisis where the interest rates spike uncontrollably.
It's the end-of-the-road scenario Schiff has been talking about for decades.
And it feels like we're finally reaching the dead end.
So what's the actionable move from Peter Schiff's discussion with Michel?
First, minimize your exposure to US dollar cash. Look at physical gold, silver, and even foreign stocks in countries with less debt.
Physical gold, like actual coins I can hold in my hand?
Exactly. Schiff has always been a proponent of physical ownership because it's the only asset that isn't someone else's liability.
He also suggests keeping a close eye on the interest expense on the debt clock.
If that number keeps climbing while the Fed tries to pause, the system is breaking.
So if I see the interest expense hitting 1 trillion or more, that's my cue to head for the hills.
Pretty much. It means the debt trap has finally snapped shut.
And by then, it might be too late to buy gold at these prices.
Got it. Less paper, more metal. I'm on it.
We are breaking down Matt deWolf's latest analysis from Trade Brigade, and the big takeaway is a massive market gap up following de-escalation news from Iran.
Matt notes that geopolitical relief is fueling the S&P 500 and NASDAQ this morning, but while the bulls are running, there's a huge risk of a gap and trap at the open.
Wait, gap and trap? Does that mean the green on my screen is a lie?
Not necessarily a lie, but Matt warns that if we don't hold the initial breakout levels, those early buyers might get stuck in a nasty reversal.
Exactly. We'll get into the specific memory names that are catching fire in a second. But first, let's look at why the macro vibe shifted so fast. According to Matt deWolf, the primary catalyst for this morning's strength is the perceived cooling of tensions between Iran and Israel.
Right. The market hates uncertainty. With de-escalation on the table, oil prices are slipping and equity futures are catching a major bid.
So lower oil prices equals happy stocks? Is it really that simple?
For today, yes, it lowers inflation fears and gives the tech sector room to breathe.
Matt's point is that the geopolitical risk-off trade is unwinding, sending traders back into growth names.
Matt deWolf is specifically watching the memory chip names today. Micron, ticker MU, and Western Digital, ticker WDC, are absolutely on fire.
He highlighted that these names are leading the charge in the semiconductor space, breaking through key overhead resistance levels.
I heard chips were in a slump. Are we saying memory is the new AI play?
In Matt's view, it's a momentum play. The demand for high bandwidth memory is real, and the technical charts are finally reflecting that.
He's watching for a continuation move above the pre-market highs.
So if MU holds its gap, it's off to the races.
Looking at the S&P 500, Matt points out that the SPY is testing a critical resistance level near 520.
That's the make or break zone. If the bulls can't hold 520, Matt expects a sharp fade back into the gap.
Wait, what's a fade back into the gap? Are we talking about a crash?
Not a crash, just a retracement. It's when the market opens high, fails to find new buyers, and drops back to where it closed yesterday.
Matt's strategy is simple. Don't chase the open. Wait to see if 520 holds as support before going long. Matt deWolf's bullish prediction involves a gap and go, where the market sustains its morning gains and trends higher all day.
For that to happen, he says we need to see strong volume and the first 30-minute low must remain untouched.
30 minutes? That seems like a short time to decide the whole day.
In day trading, the first 30 minutes set the tone. It's where the big institutional smart money often shows its hand.
If Matt's gap and go plays out, we could see the S&P test new weekly highs by the closing bell. Matt's final takeaway? Use a 5-minute opening range breakout strategy to manage your risk today.
Right? If the stock breaks above the high of the first 5 minutes, you have a clear entry. If it breaks below the low, you stay out.
So keep it simple. High of 5 minutes is good, low is bad.
Exactly. It's about protecting your capital in a volatile, gap-up environment.
Follow Matt deWolf's levels on Micron and the SPY closely. Today is all about whether the momentum is real or just a trap. Goldman Sachs just dropped a bombshell, confirming what Jeff Snider has been shouting from the rooftops. The worst-case economic scenario is officially on the table.
Exactly. Goldman's data shows credit availability is contracting at a rate we haven't seen since the Great Financial Crisis.
Wait, so the big banks are actually admitting things are going south? That sounds like a sell everything signal.
It's a huge shift. While the Fed talks about a soft landing, Goldman's internal metrics are screaming credit crunch.
And while we're talking about the bank's fears, Snider points to a specific signal in the bond market that suggests the Fed is totally flying blind, which we'll get into shortly. Jeff Snider highlights that Goldman Sachs is seeing lending standards tighten for 45% of small businesses.
Right, and when small businesses can't get loans, the engine of the economy effectively stalls out.
45%. That's almost half the small businesses in the country getting the cold shoulder from banks.
Precisely. It's not just a maybe anymore, it's a measurable freeze in the wholesale funding markets.
So the plumbing of the financial system is basically clogged with rust and broken dreams.
I think I'll stick to my piggy bank for now.
Jeff Snider points out that the Eurodollar system is showing a liquidity gap of nearly $1 trillion.
That's the hidden plumbing of global finance. If that 1 trillion isn't flowing, the whole world feels the squeeze.
Hold on, a trillion with a T. Where did all that money go? Did it just disappear?
It didn't disappear, it just stopped moving. Banks are too scared to lend to each other, so they're hoarding cash like it's the end of the world.
It's the ultimate game of musical chairs, and Goldman Sachs just realized the music stopped 5 minutes ago.
And here, I was worried about my $20 ATM withdrawal limit.
The analysis from Snider also touches on Goldman's fear of a 25% drop in commercial real estate.
With office vacancies at record highs and interest rates up, that 25% might actually be optimistic.
Wait, so all those empty office buildings downtown are basically ticking time bombs for the banks?
Exactly. Banks hold those loans. If the buildings lose value, the bank's balance sheets go up in smoke.
It's a classic domino effect. One building defaults, the bank tightens credit more, and the cycle repeats.
Note to self, don't buy a skyscraper this weekend.
Jeff Snider focuses heavily on the yield curve, which is currently signaling a 90% chance of a recession.
The bond market has a much better track record than the Fed. When the curve inverts this deeply, it's never been wrong.
Can someone explain inverted yield curve in English? Is it like a roller coaster going backwards?
Sort of. It means people are so worried about the near future, they'd rather park money for 10 years than 2. It's a massive red flag.
It's the market's way of saying something is fundamentally broken in the economy.
90%? I don't like those odds. Can we go back to the roller coaster?
Based on the credit data, Snider predicts the Fed will be forced to cut rates by the third quarter of this year.
They won't want to, but the systemic risk will get so loud they'll have no other choice but to pivot.
Isn't cutting rates a good thing? Like lower interest for my credit card?
In a vacuum, yes, but they only cut that fast when they're trying to put out a massive fire.
It's a break glass in case of emergency move. If they're cutting, it means something already broke.
So it's a good news because things are terrible situation. Got it.
Snider warns that as credit dries up, unemployment will likely spike above 5%.
When businesses can't borrow, they stop hiring and start firing. It's a lagged effect, but it's coming.
5%? We've been at record lows for so long. That's going to hurt a lot of people.
It will. And the Fed is currently looking at last month's data while the credit cliff is happening right now.
It's like driving a car while only looking in the rearview mirror.
And the car is headed straight for that skyscraper we aren't buying.
Snider's main takeaway is clear. Liquidity is king. He suggests everyone should aim for 6 months of cash reserves.
If the credit markets freeze, you don't want to be relying on a bank for a loan or a line of credit.
6 months? I'm working on 6 days right now. How am I supposed to save that much in a crunch?
Start small, but start now. Cut the fluff and prioritize safety over growth until the dust settles.
In this environment, return OF capital is more important than return on capital.
Okay, so focus on not losing what I have. I can get behind that.
Finally, Snider recommends watching the 2-year and 10-year Treasury spread like a hawk.
If that spread starts to rapidly de-invert, it's the signal that the recession has actually arrived.
Wait, so if the curve goes back to normal, that's when we're actually in the trouble.
Exactly. The uninversion is the final warning before the storm hits the shore.
So keep your eyes on the bonds and your cash in the vault.
Bonds watched, piggy bank guarded, ready for whatever Goldman Sachs throws at us.
Today we're looking at a massive red flag from Nick Gerli, who says the US Fed just triggered its biggest warning since 2007.
Nick's analysis shows bond yields are going parabolic, which is basically the financial version of a heart attack for the housing market.
Wait, 2007? As in the year before everything crashed?
Exactly. Nick's pointing out that we haven't seen yields move like this in nearly 20 years, and it's not looking good for buyers.
Nick describes the 10-year Treasury yield as the Godzilla of the economy. It's the benchmark that sets interest rates for everything.
So if Godzilla wakes up and starts stomping, my mortgage rate is the first thing he squashes.
Pretty much. When that 10-year yield spikes, borrowing money for a house or a car gets way more expensive, way faster.
And according to Nick, this spike is happening right as the Fed is trying to hold rates at their peak.
Nick Gerli emphasizes that the 10-year yield surging past 4.8% is a massive shift from the low-rate era we're used to.
It's all about the term premium returning. Investors are finally demanding a higher return for the risk of holding debt for a decade.
Hold on, 4.8%? That doesn't sound like a big number when my credit card is at 20%.
In the bond world, that's huge. It's the difference between a housing market that flows and one that completely freezes over.
Nick notes that with yields rising, mortgage rates are knocking on the door of 8%.
At 8%, the monthly payment on a median-priced home is nearly double what it was just 3 years ago.
Who can actually afford that? I feel like I'd need 3 jobs just to cover the interest.
That's Nick's point. Demand isn't just cooling, it's hitting a brick wall, because the math just doesn't work for the average family.
Nick's discussion highlights that while inventory is low now, higher rates create forced selling situations for investors with adjustable rate debt.
So people who are flipping houses might suddenly be in a rush to get out.
Exactly. If they can't refinance because rates are too high, they have to sell. And when they do, inventory spikes.
It's a domino effect. Higher yields lead to higher rates, which leads to forced sales, which finally brings prices down. Now, Nick also mentions the yield curve is starting to uninvert. For the non-nerds, why is that scary?
Historically, the recession doesn't start when the curve inverts. It starts when it rapidly uninverts like it's doing now.
So we're in the danger zone right now. Why aren't more people talking about this?
Because it's a lagging indicator. By the time it's obvious, the recession is usually already here.
Based on these yields, Nick Gerli is predicting a housing price correction of 15 to 20% in the most overvalued markets.
We're talking about places like Austin, Phoenix, and Boise, where the bubble was the biggest.
Wait, 15% off? That might actually make a house affordable for me.
Maybe, but remember your mortgage rate will be much higher, so your monthly payment might still be a struggle.
Nick also warns that the Fed's higher for longer stance will eventually hit the job market.
When companies can't borrow cheap money to expand, they stop hiring and start cutting.
So it's not just my house, it's my paycheck too. This is getting dark.
It's the harsh reality of the Fed trying to kill inflation. Nick says they won't stop until something significant breaks. Nick's biggest takeaway: keep a close eye on that 10-year Treasury yield.
If it keeps climbing toward 5%, expect even more volatility in stocks and real estate.
So if I see that number go up on the news, I should probably put my house hunting on hold.
That's exactly what Nick's data suggests. Cash is king when rates are this high.
He also suggests monitoring local housing inventory. If you see a sudden surge of listings in your area, that's your signal that the correction is starting.
Got it. Look for sale signs like they're a weather forecast.
Exactly. Thanks to Nick Gerli's insights, we've got a roadmap for what's coming next.
Buckle up, because the next 12 months are going to be a wild ride.
Gold is officially breaking down today, and Chris Vermeulen says we are entering a critical pivot point for precious metals.
Chris notes that the technical support gold has held for weeks is finally giving way, which usually triggers a cascade of selling.
Wait, breaking down? Does that mean my gold coins are worth less now, or is this just a temporary dip?
In the short term, Chris sees more downside risk. When these levels break, the next stop is often much lower.
He's also posing what he calls the coin toss question. Are we seeing a market top or just a breather?
Right, the data shows high-growth tech is holding up while metals slide. It's a 50-50 bet on which one leads the next big move.
A coin toss? That sounds like gambling, not investing.
It's Chris's way of saying the technical indicators are currently at a stalemate, and we need a clear break to pick a side. Vermeulen highlights that gold miners like GDX and GDXJ are already showing significant weakness ahead of the metal itself.
Exactly. Miners usually act as a leading indicator. If the companies digging the gold are losing value, the gold price usually follows.
So the miners are like the canary in the coal mine? Pun intended.
Spot on. GDX is down significantly today, confirming Chris's bearish technical outlook for the sector.
One major factor Chris points to is the US dollar index. When the dollar goes up, gold typically feels the heat.
The dollar is pushing toward new highs, which acts like a lead weight on precious metals.
Wait, why does a strong dollar hurt gold? Shouldn't they both be safe havens?
Gold is priced in dollars. If the currency you use to buy it gets more expensive, you can buy less gold for the same amount. It's basic math.
Chris Vermeulen's charts show gold is flirting with its 50-day moving average. If that breaks, look out below.
He mentions that the 50-day has been a floor for months. A daily close below that would be a massive red flag.
Red flag? Like, sell everything and run for the hills. Red flag?
Maybe not run for the hills, but Chris suggests it's a sign to tighten your stops and protect your capital. While gold is struggling, Chris notes that the S&P 500 and the Nasdaq are actually holding their ground.
It's a strange divergence. Normally they move together during uncertainty, but right now, investors are favoring tech over bullion.
So people would rather own an AI company than a bar of gold right now.
According to the price action Chris is watching, yes. Capital is rotating out of the safe haven trade and back into growth.
Chris predicts that if this breakdown holds, gold is likely heading toward the $2,300 level.
That would be a healthy correction in the grand scheme of things, but painful if you bought at the top.
2,300. That's a huge drop from where we were.
It is, but Chris views it as a necessary reset. Markets don't go up in a straight line forever. And Vermeulen is also warning about silver. He thinks a washout event is coming where prices drop rapidly to shake out weak hands.
Silver is always more volatile. Chris suggests it could drop 5 to 8% in a single week if the support fails.
A washout sounds messy. Is that when everyone panics and sells at the same time?
Exactly, and for seasoned traders like Chris, that's often when the best buying opportunities finally emerge.
The main takeaway from Chris Vermeulen's analysis is to manage your risk. Don't go all in during a coin toss market.
Right, use stop losses and keep your position sizes small until the trend clearly turns bullish again.
So basically, don't bet the house on gold today.
Exactly. Chris recommends staying patient and letting the market tell you when it's finished corrected. Finally, keep a close eye on the US dollar. If it starts to weaken, that's your signal that gold is ready to bounce.
Until then, Chris's charts say the path of least resistance for metals is downward.
Got it. Watch the dollar, watch the 50-day average, and try not to panic. Seems simple enough.
Simple in theory, much harder when your portfolio is flashing red. Trust the charts, not your gut.
First up, George Gammon, who argues that a $300 billion decision set the stage for the dollar's impending downfall.
Right. He's linking that staggering figure to the broader issues of liquidity and economic stability. It's a critical moment.
So basically, one big blunder has us on a financial tightrope.
Exactly. Educating everyone on that mistake is crucial. Next, we have Peter Schiff, who underscores the serious implications of our colossal national debt.
Schiff emphasizes that without a fundamental shift in policy, we could face dire economic repercussions.
So he's saying we need to rethink everything we know about fiscal policy.
Pretty much. The urgency in his voice makes it clear. Jeff Snider points out the looming credit crunch as a result of ongoing mismanagement.
He argues that the impact of these policies could significantly tip us into more severe economic conditions.
Hold up. So is he implying that all these financial policies are just asking for a meltdown?
You got it. It's a precarious situation. Then, Nick Gerli raises the alarm regarding the housing market as interest rates climb.
He argues that the increases are making homes unaffordable for most buyers.
Oh, great. My dream of home ownership just got another nail in the coffin?
Unfortunately, yes, it's a tough market out there.
One key takeaway is the agreement among all guests regarding the U.S. debt situation.
They all emphasize that this unprecedented debt burden is a significant risk.
So they're all in on the idea that some serious changes need to happen.
Exactly. They see this as a critical junction point. Interestingly, Peter, Jeff, and George all share skepticism about the sustainability of current monetary policies.
They highlight the risks inherent in continued monetary easing.
Wait, so they're saying that just pumping money isn't going to work forever?
Yes, they're all sounding the alarm on this. Nick and Jeff also agree on the crucial link between the housing market and credit availability.
They argue that a credit crunch will directly spill over into housing.
So if credit dries up, my chances of owning a home dry up too.
Exactly, both emphasize that relationship.
Now to the disagreements. George is advocating for a quick reset of the financial system.
In contrast, Peter cautions against such a swift approach, fearing it could lead to disaster.
So one wants to hit the reset button, and the other is saying, not so fast. That's a huge divide.
Indeed, their timelines and proposed actions are miles apart. Jeff Snider is more cautious about the Fed's actions, suggesting they could lead to negative outcomes.
Meanwhile, George pushes for proactive measures. He feels we can't just stand still.
So one believes the Fed's inaction is a problem, but the other is worried about their actions.
Spot on. It's a real paradox in their approaches. Lastly, Nick is predicting an imminent crash in the housing market.
On the other hand, Peter sees things with a bit less alarm, questioning how severe the crash will be.
So one is packing for the worst, and the other thinks it's just a bump in the road.
Exactly. Their perspectives illustrate how economic forecasts can differ drastically. If you found this deep dive into expert opinions fascinating, make sure to hit like and subscribe.
We strive to break down complex financial insights, making them accessible for everyone.
Trust me, this saves me so much time. I can't imagine going without it.
Join us again soon for the next round of expert analyses. See you next time.